If rates stayed stickier, higher, longer, like a lot of people think, I think that's going to be a bigger concern down the road. But I just don't think that's going to be the case. I do believe that rates are going to go down a little sooner than what people predict. And I think that inflation's going to, and that's because inflation's going to come down to levels that the Fed is going to be able to, or be forced to, in some cases, maybe a lower rates down the road. When it comes to investment capital and where people should put it, if you put money that was sitting in 0% checking accounts and you put it into short-term, money markets and CDs and bonds, that's phenomenal that you did that as an investor. But if you took money out of the stock market, think about what happened so far this year. Think about where we're at in S&P 500. Or is it a surprise that the big, the Magnificent Seven now, the big mega cap tech is up so much this year, and the NASDAQ 100? Probably not. A lot of those are good companies to own, even in a slowdown. And they were so hurt last year and went down way more than the market did. I'm not surprised at all that those stocks are up. And so I do believe that after we get through a little bit of a lull and we get probably a rate hike, at least one, that there's another run possibly for tech in the second half of this year, if and when we do get the pause, and if we end up actually getting a rate decrease in 2023. And on the other end of the barbell, I would play some safer sectors. Our investment committee studies relative strength in areas or sectors such as financials and industrials have really picked up momentum in the last 60 days. So I think those are different ways that you can play the market.